Letting your emotions dictate trading decisions is the fast track to failure. I'm going to teach you how to keep them in check. Revenge trading occurs when a trader hastily re-enters the market after a big loss in an attempt to get back to flat. This impulsive action is often fueled by a mix of emotions: anger, fear, shame, even arrogance. These can be grouped together under letting your ego take control. The market, however, doesn't care about individual losses, and it certainly doesn't care about your bruised ego. Such emotionally driven decisions often lead to greater setbacks. Imagine a scenario where a trader, let's call him Max, experiences a significant loss. The immediate emotional response is a mix of frustration and the urge to rectify this loss as soon as possible, and this is where the danger lies. Max, driven by a cocktail of negative emotions, jumps back into trading, often with increased risk, hoping to recover all of his losses in one go. This is the essence of revenge trading, a cycle of loss, emotional reaction, lack of discipline, and impulsive re-entry into the market. Considering the potential impact of revenge trading, it is in every trader's interest to learn how to manage their ego. And here's 3 ways to fight the urge. 1. Taking a step back. The first and most crucial step is to take a pause. This isn't just about cooling off, but about gaining a much-needed perspective. In the heat of the moment, stepping away from where you're trading can prevent hasty decisions. It's about breaking the cycle of emotional trading. Number 2, reassessing the market. Now, before jumping back in, it's vital to reassess the market conditions. Are the markets too volatile? Are there identifiable trends, or is it just chaotic? Understanding the current market scenario is the key to deciding whether it's wise to trade at that moment. One sanity check I use in these difficult times is an index which can track how volatile the market is and how logical it is acting. Think of it as a fear index. If you Google search VIX index, you will find a number between 10 to 40. The higher the number, the more dangerous the market, and if the number is above 25, it usually means avoid jumping straight back in. Number 3, evaluating and adjusting your trading strategy. We all know after losing a lot of money, the last thing you want to do is readjust your trading strategy. It's like being knocked down in boxing. All you want to do in the next round is get back out fighting. However, the correct thing to do in trading is to sit down and assess what went wrong. This involves a thorough review of your trading strategy. Is it aligned with current market conditions? It's essential to reevaluate your rules around entry, exit, and stop losses to ensure they are not based on impulsive decisions, but on solid, well thought out plans. For me, it happened many times in my career. Maybe I was overconfident in a position and just went too big too soon, and the market turned against me. Well, the first instinct is that the market now owes you something, so you just jump back into the trade. But it's just not the case. What used to really help was going for a walk around the block. Get some fresh air, even if it's just for 10 or 20 minutes. Helps put things into perspective. I would speak to other traders. Was there something that I had missed? Had something about the fundamentals changed? Now, if you get back to your desk, and the fact is that you've become even more confident in the position, then by all means go back into the trade. However, the important thing is to take the emotional response out of it. Revenge is a dish best served cold is a proverb that works very well for trading. Rather than rushing into the next trade to offset any losses, stay disciplined. Success may not be quick, but it sure as hell will be easier if you're trying to regain 10% of your capital rather than 30%. Be sure to subscribe to our Trading Takeout series on YouTube for a daily dose of market insight and wisdom.